right, welcome to Session 7. Session 7 and Session 8, we are looking at bookkeeping, putting the roof on our business. And specifically in Session 7, we will be looking at record keeping, accounting equations, and cash and non-cash transactions. I know from teaching this many times that this is not the favorite for many people. For some reason, we have challenges when it comes to math, and yet God is calling us as the owner of the business. He is calling us as managers to understand what is happening from an economic perspective. Remember, our call is to be fruitful and to multiply, and we have an economic bottom line, and so therefore we need to have an understanding of what is happening financially in the business if we want to be able to help it to grow. There are so many different texts that talk about money in the Bible, so many, and a few of those are the ones that are encouraging us to make sure that we are also paying attention to this. Proverbs 13, verse 11 says, "Dishonest money dwindles away, but he who gathers money little by little makes it grow." Oftentimes, we would like money to come fast. But one of the things that we know is for those people who play the lottery and win, that they tend to, 4 out of 5, I think, tend to declare bankruptcy within several years. And so money that comes quickly is often money that we haven't really learned how to handle and manage. So we want to ask God to let us gather it little by little so that we can learn how to manage it. But of course, the important thing is that we gather it honestly, and that we have integrity as representatives, as ambassadors of the Most High God. Integrity on how that money is acquired. Proverbs 11, verse 1 says, "A false balance is an abomination to the Lord, but a just weight is his delight." Those are strong words to say that a false balance is an abomination to the Lord, but a just weight is his delight. And I know that there are challenges, especially with poverty, in how we go about doing our business. I remember working in Liberia, and the women who were selling rice or beans by the cup, would sometimes melt wax at the bottom of it so that people couldn't see that they weren't getting a full cup. And the justification from their side is, we're trying to feed our family, and that is a noble desire, to feed your family and to care for your children. And yet we're reminded here again that we need to do it in an honest way with integrity, allowing God to draw near us in that, rather than finding ways to shortcut and to cheat other people in order to pull ourselves ahead. Proverbs 30, verse 8 says, "Keep falsehood and lies far from me. Give me neither poverty nor riches, but give me only my daily bread." And this is one of my favorite passages, because it's reminding us again that to be wealthy, there are many temptations with that. Most of us would not be able to manage it well and handle keeping God on the throne if we had a lot of money. On the other hand, poverty also causes us to sometimes steal and do dishonest things. And so in this verse, we're being asked to pray that God gives us neither poverty nor riches, but just enough to keep us fed. And so that's an important prayer, I think, that we remember as well. Matthew 6, verse 24 says, "No one can serve two masters, for either he will hate the one and love the other, or he will be devoted to the one and despise the other. You cannot serve God and money." And so in this, of course, we are recognizing that as we do business, we don't do it for the profit. That is not the end goal that we are working towards. It is a means to an end. The profit is what allows us to grow the business so that we can help more people to flourish. And so we are being called to make sure that God continues to be on the throne, that we do our business to help people flourish because God is the owner. And that keeps money and wealth in its proper place. And when we start flipping those, where we start doing business just for the money, that leads us in a great temptation to serve a different master. So I think we need to have some thoughts and discussion about these questions. What does it mean to do money management God's way? How is it that it looks when we are doing money management God's way? Is God an accountant that wants us to have many different ledgers? What does it mean, really, practically, to do money management God's way? What does it mean to not do money management God's way? What are the temptations that keep us from doing money management in a way that brings glory to God? So I want you to pause right now and to have a discussion about what these three questions. What does it mean to do money management God's way? What are some examples that you've seen of people who do it well? What does it mean to not do it God's way? And what specifically are the temptations that we have as Christians doing business to do money management the world's way? So take a few minutes and then we will come back. Okay, I hope you had a good discussion and had some discussion about why it is such a challenge for us to do money management God's way. A survey was done by Sales and Marketing Journal, and they found that 58% of people in business cheat on their expense reports. So they are claiming some things to be expenses that aren't. They are increasing the amount that was spent on expenses and pocketing the money. 50% work a second job on company time. And so that also is cheating, right? When we are supposed to be full-time on one job, but we are using some of that time that we are being paid for one place and using it to gain additional funds is a dishonesty. 36% rushed closed deals through accounting before they were really closed. And so, again, it is trying to make a claim that is dishonest. It is trying to make it look like we have something that we don't quite have yet. And that's another temptation. And 19% give a kickback to the customer. So you make a deal and you pay that person for the deal. And so it looks like you're making good sales, but actually what you are doing is paying some of your customers to be customers. So these are some of the temptations that we face to be dishonest in doing our business. Again, as I mentioned, we are looking at the roof of the business at this time. What does it mean to have a roof on your business? What does it mean to be doing bookkeeping in a way that's going to protect what is inside the business, protect it, to shield it, to allow it to grow, to flourish? What does it mean if we don't have a roof at all, if we're not doing any bookkeeping? What are the chances of things being damaged and spoiled and the wind taking things away without us realizing it? So that is the aspect right now that session 7 and 8, we are looking at roofing the structure of our business. How many of us believe it is important to keep financial records? How many of us believe that it is important to keep financial records? And the next question then is, how many of us actually keep financial records? I want us to pause again and have a discussion about this. Do you believe it's important? And are you doing it? What I find is that for many people, we believe it's important, but we're not doing it. So I'd like you to have a discussion about why there is that potential inconsistency, and then we will pick up again. So if you are like many other groups that I have taught over the years, we believe it's important to keep financial records, but we don't do it. And so there's an inconsistency between our values and our actions, which really, again, means that it's not something we value. We only believe that we should value it. So why is this? Why is bookkeeping important? Those are a question that we want to answer. How does it keep a business going? And of course, we know in our heads, in our brains, that bookkeeping is important if we want to be able to measure growth. If we want to be able to see where funds are going, where we have spending leaks, the business might be leaking some money, what it is that we are actually taking from the business, how is the business helping us, and that's actually what will feed us the information to make decisions about where to grow a particular aspect of the business, maybe a particular aspect of the business that we need to give up, that it's not producing what we need it to produce. I remember working with a farmer one time in Kenya, and she said very honestly, I don't want to keep records. I don't want to, if I see what I'm actually putting in and what I'm getting out, I know I'll quit. So I just don't want to know that I'm probably losing money every single season. And we need to understand that when that happens, when we're doing business and we're not making a profit, it's not actually a business anymore. It's more of a hobby. It's something that we're doing to keep ourselves busy, and maybe somebody or family member is giving you some capital injections. And so you're doing something to stay busy, but you're not actually being fruitful and multiplying, growing what it is God has given you to grow. And so we have to take hard looks at income. What prevents people from keeping records? There's many different things. And I'm sure that you said that some of the things are time. I'm too busy. Some things people say is, I just don't know how to do it. Some people say, it's so small, I know everything that's going on. But one of the things that we need to keep in mind is that record keeping is not an end in and of itself. It's a means to an end. The end being that we can make good financial decisions. And we are called, again, as managers of a business that God owns. And as a manager, we have a responsibility to know all things about the business so that we can make good decisions. So we keep records, but those records need to inform us so that we can make managerial decisions. The end is to improve the operation and the profitability of a business so that we can continue to grow it, provide more jobs for people, provide more goods and services for people, to help the customer flourish and to help employees flourish. Reasons that we keep books, more reasons. Records help us understand what is going on in the business. As I said, it's going to help you know what parts of your business are more profitable than other parts. Sometimes we keep the ones that are less profitable because those are the things that bring people into the business and allows them to see the other pieces that are more profitable. It helps us to know what seasons are more profitable, what times of the month might be more profitable, and all of that allows us to respond better for the customer. Second, the records enable you to analyze past business performance and make necessary changes to improve your performance. And so as you look back, it predicts how to move forward. And so we say that it is a chance for us to see history in order for us to make decisions about the future. Records help you know the inflow and the outflow of your money. Sometimes we have more outflow than inflow. As I said earlier with the farmer, we need to know that and understand that and take those difficult looks. Records serve as a historical account of your business and can be used for future reference. And so as you are being able to advocate for yourself, for your business, to be able to take a loan, to be able to get a contract, it again helps to have that history so that you can also predict future performance. Records allow for fiscal accountability within and outside your business. So it proves that you are fiscally responsible. It proves transparency and accountability, something that we expect from our government, we expect from our schools, we expect from our church leaders, and we should also have that same expectation for ourselves in God's business. Records give you a way to monitor and evaluate whether or not you are making or losing money. And so again, that's critical as you make decisions. Record keeping helps to track your employees' progress and to help keep them and yourself honest. And sometimes we miss this. We think, we don't really need to do it. We're so small. But what happens when you don't keep records is there's the temptation through a lack of internal controls. You are opening the door for temptation, both for yourself as well as for your employees. And so record keeping is a way of helping people stay honest. We need to be, again, accountable for the money. And we don't want to lead people into temptation that, well, nobody's looking. And after a while, you begin justifying it to yourself. And that gets people into a lot of challenges morally, in terms of their own integrity, in terms of their own ability to be in a healthy relationship with God. Records are often legal and regulatory or a requirement for other tools such as loan applications. And so we pay taxes, and we believe that it's the right thing to do to pay taxes. We might not be happy about it, but it's the right thing to do. And so in order to know what your tax rate is, you have to be keeping records. And so it's one way to show that integrity and that honesty as well. If you don't keep accurate records, you can't measure your business's progress. If you can't measure progress, you can't manage it. If you can't manage your business properly, it won't succeed. And so these are some things to think through. Do we want to be able to measure our business's progress? We want to be able to manage it. And I know that everybody says that they want a successful career, a successful business. And yet, if we aren't taking the time to do this, we are really shooting ourselves in the foot, so to speak. We are not giving ourselves every opportunity to be able to measure that progress and then be able to manage it. Records can help you answer questions that business people ask every day. First question, which of my business products are the most popular? Second question, what expenses are associated with the goods I sell? The third, have I earned more money than last month or last year? And the fourth, what trends are there with your customers, with the seasons, etc.? And so those are some of the questions that records can answer. And those are important questions for us to have a good understanding of as we are managing our business. I'd like you to pause again and have some discussion about what you are hearing so far about the reasons to keep records, the need for keeping records, what it is that you believe that you could learn better about your business than you know right now by keeping records. And so take some time to pause, and then we will come back. All right, one of the things that we tend to hear are two main excuses that people use. The first is, my business is so small that I know everything that is going on. This, again, is something that many of those who are in micro businesses will say. And that's a false assumption that can hurt your business. If your business is small now, it will stay small if you don't make changes for growth. And so you might think that you know everything that's going on, but you also may have spending leaks, you may have patterns that you're missing, and if you do want your business to grow, you need to start with it at a micro level to be able to manage that growth to grow to the SME level. Another excuse, I'm just too busy to keep records. My pastor always told us that he didn't want to hear the excuse of being too busy. He said, you are an adult, manage your schedule. And so it has to do, when we say we're too busy, we're really saying it's not a priority, it's not a value. If it's a priority and a value, you will find time for it. And so if you do want your business to grow, then this is one way that you show that, by making this a value, that you will spend time on a weekly basis, on a daily basis, doing some of the basic details, but on a weekly basis, digging deeper, taking 1-2 hours every week to really dig into what is going on financially in your business. So saying you're too busy doesn't work. If you want to be honest, then say it's not a value, it's not a priority, and that would be a more likely scenario. Again, understand what your values are, and what you value is what shows up on your calendar. Do you know how many days it takes to create a new habit, be it a good habit or a bad one? And some people say 21 days, we say 30 days. It takes 30 days to create a new habit. The habit is something that you do without even thinking. So, for example, for me, brushing my teeth, I don't ever have to think through how to brush my teeth. I just do it. It's a habit. It's a habit when I get up. It's a habit when I go to bed. And to develop a good habit or a bad habit, it takes 30 days. And so we want to say that it's going to be similar with bookkeeping. We start with doing it, and we say that we are going to develop it into a habit, knowing that it may take a good 30 days for that to happen. I want you to do something. I want you to take your hands, and I want you to interlock your fingers together, all right, in a way that's comfortable. So for me, when I do that, my left thumb is on top. I don't know which thumb is on top for you, whether it's your left or your right. But whatever it is, now I want you to unfold and move your fingers so that they interlock in the other way. And so your other thumb is on top. And how does it feel? For me, it feels uncomfortable. I don't like that feeling. This feels very comfortable. This feels uncomfortable. And so my temptation is to go back to what is comfortable. This is what I know. This is what feels good. But the truth is, if I did this every day for 30 days, eventually this would feel comfortable to me and it would feel okay. And it's the same with bookkeeping. It's going to feel uncomfortable. The temptation is going to be to go back to what we know. But we want to challenge ourselves to say it's okay to be uncomfortable. And it's okay to have that temptation, but again, we're striving for something better. We're striving for something different in our business. The financial planning process has 3 main steps to it, and we call it plan, do, review. Plan, do, review. So turn to your neighbor and say, plan, do, review. All right, the first step is planning, and in order for us to be able to develop a process, we have to first set a plan, and that involves setting a budget, because once we set the plan, then we need to start acting on it, which is the doing. You start receiving funds and spending funds based on the plan. But then we need to review and say, is the plan correct? Was the plan a good one? What do I need to change? Maybe I had less income. Maybe I had more expenses. Was the plan wrong, or was my spending wrong? And so we have to review and then restate the plan and then start the cycle all over again. So it's a cycle that goes round and round and round and should really never stop. You make your plan, you do it for a period of time, and then you review it. You probably need to change the plan again, and then you do it for a period of time, and then you review it. And again, if you need to change the plan, until you get to a place of having a good rhythm. But you still may need to change that plan because the good rhythm may allow for growth. And as you grow, you still need to plan what to do with the extra income or the additional expenses and how to manage that. So think in your mind, both for your family financial plan as well as your business financial plan, that these are the 3 key steps. Many of us do the plan part, and then we don't ever execute. Or the thing that we often do, we do a plan, we start doing the work, but there's no connection between the planning and the doing. And the one that we most often forget is the reviewing. And really, to set a plan and then just to do whatever doesn't make any sense. To not review and then make changes to the plan will not allow for there to be good progress. We want to define the difference between bookkeeping and accounting. Bookkeeping is an indispensable subset of accounting. Okay, so accounting is the overall, and bookkeeping is a portion of accounting. Bookkeeping refers to the process of accumulating, organizing, storing, and accessing the financial information base of an entity. Okay, so accumulating the information. Sometimes that's all we do is just gather it. We need to then organize it. We need to store it, and we need to be able to access it in order to make good decisions for the 2 purposes. 1, facilitating the day-to-day operations of the entity, and 2, preparing financial statements, tax returns, and internal reports to managers. Okay, so we are doing this process of accumulating, organizing, storing, and being able to access the financial information so that day-to-day activities can be run. We have the money for our expenses. We have the money to pay people. We have the ability to collect money from customers, but also so that we can prepare financial statements, our accountability things to the government, and to be able to prepare reports so that we can make decisions for the business as managers. Bookkeeping, some people also call it record keeping, can be thought of as the financial information infrastructure of an entity. The financial information base should be complete, accurate, and timely. And so bookkeeping is the infrastructure. It is the collecting of income coming in, the recording of income going out. And that is the essence of bookkeeping. And it is the infrastructure. It's what is happening on a regular basis to help make those decisions. Every record-keeping or bookkeeping system needs quality controls built into it, which are called internal controls. And these are critical. Without internal controls, without safeguards to protect the assets of the business, to protect your employees, to protect yourself from temptations, your accounting plan, your bookkeeping can fall apart very quickly. And so we want to look a little bit at that shortly. Accounting is bigger than bookkeeping. The term accounting is much broader. It is the designing of the bookkeeping system, establishing controls to make sure the system is working well, and analyzing and verifying the recorded information. Accountants, therefore, set up the system. They give the orders for how the bookkeeping is to be done. The bookkeepers then follow the system. Accountants also help design the internal controls for the bookkeeping system, and those internal controls are relied on to detect and deter theft, embezzlement, fraud, and dishonest behaviors of all kinds. And I think many of us can tell stories, whether it's a story from a church, whether it's a story from a business, whether it's a story from an NGO where there has been embezzlement and theft. Certainly we can go back to even Genesis chapter 3, the first accounting of embezzlement, where the managers took what didn't belong to them from the business. And so internal controls need to be set up, and that's part of the accounting system to help protect the business as a whole. So bookkeeping is a subset of the whole accounting system. The whole accounting system might be set up by an accountant, it might be set up by you, the manager, and the bookkeeper does the implementation of that as it relates to recording. But as a manager, you are the one that needs to keep control over the internal controls. Accountants tend to trust the system more than the people. So they set up the system and they tend to trust that the system will work. Accountants prepare reports based on the information accumulated by the bookkeeping process. The financial statements, tax returns, and the various reports to the managers. That's what the accountants are doing based on what the bookkeepers are accumulating the information for. Why should an organization's records be auditable? We believe that every organization, every business needs to have an audit, and that is, in essence, good stewardship. Stewardship is an ethic that embodies responsible planning and management of resources, and we believe that God has asked us to be fruitful and multiply, but He's also asked us to subdue and to reign as responsible caretakers of creation, of the business that He has given, of helping people flourish, and that means that we need to be managing our resources in a way that is forthcoming to show that we are good stewards, and that often happens through an audit. We tend to only think of the management of resources, and we forget about the planning. And so if we don't plan, it will be difficult to succeed. And so we need to be able to plan through these internal controls, through the bookkeeping system, through the accounting system, how to manage all the different various aspects, which are going to be different in every business as well. We talk about financial accounting versus management accounting. Our goal is not to make you, as a business owner, an accountant, but we do have some responsibilities as managers to understand the accounting. So on this slide, we want to look at the left side for financial accounting. And this would be what a bookkeeper and the accountant would be likely doing in your business. Maybe you are doing everything, but if you have somebody assigned to that, this is what they would be doing. They would be recording transactions, income coming in, money going out. Very simple. Classifying transactions. What type of income did we have from sales of products? What type of income did we have from services? What type of expense did we have related to our variable costs, which we talked about last session, related to our fixed costs, related to salaries? Then reconciling the records, income in, income out. It should tell us what is our net income, or our gross income, and then our net income for the month. After we pay all of our expenses, what are we left with? And that should reconcile with what we actually have. Financial accountants are going to then summarize those transactions and put them into reports, present the financial data. And so as managers, we can look very quickly to say, okay, it is March 2020, and I see that we had this much in sales of product, this much in sales of services. We had paid this much in terms of the various expenses overall. This is how we did for the month. What needs adjustment? And it's now we go to the other side, the management accounting, where we take that financial data and we begin to do things with it. So the first thing that in management accounting you would do is to compare the results against the goals. We thought that in March we would make this amount, but this is what we actually made. If it's less, why was that? We didn't meet our goals. If it's more, that's great. But again, why was that? Why was it that we were able to go higher so that we can maybe take advantage of that again in a future month. We then, as managers, need to determine the reasons for the variations and then identify corrective action. So it didn't go well because there was heavy rains in March. Okay, that was earlier rain than what we had anticipated. There's not a lot that we can do to mitigate against rain, but what could we do to boost our sales in other ways if it's a rainy period? Forecasting and planning, then, what does this mean for the future? If we continue to not meet our goals, that's going to run into a problem. What do we need to do to try to correct this and to plan differently and then analyze the information that we have? Again, remembering that there's only 3 ways to increase profit. Increase your price, usually doesn't go over well. Decrease your cost, that's something that you can always look at. And then increase the amount of sales. And so how do we look at what actually happened and begin to plan for the future to analyze that information? In accounting, there are 3 main activities that we look at. First, we need to identify and select the economic events that are happening. What are the events that we need to be capturing in the business? The second, then, is to record those events. We record them, we classify them, and we summarize them. Those are the 3 things that are done. And then the communication is the third part. We prepare the reports, and next session we will talk about income statements and balance sheets. And then we need to be able to analyze and interpret those reports for those decision makers, those managers who need to make decisions based on what was recorded. Okay, so 3 main activities: identification, recording, and then communication. As I said, there are 2 main financial documents that we will talk about next session, that our goal is, as we collect our income in and our expenses going out, we want to work towards having an income statement on a monthly basis. Some people call it a profit and loss statement. What was the total of income that came in, expenses that went out? Did you have an overall profit for the month, or did you lose for the month? The second report that we want to create is a balance sheet, and that relates to the business's value over all of the assets. So what assets does the business own? What is the value of those assets? How do we explain those assets? We can explain them either in liabilities, maybe we took a loan and that explains the assets, or it will also show the owner's equity, which is made up of the profit that the business has earned, the capital that the owner has put in, and so on. And so we want to see, is our balance sheet, is our net worth as a business increasing over time? Is it decreasing? And these are the 2 main documents that we believe every business should be actively involved in collecting in order to make good decisions. Something that if you have an accountant in the room, I would ask you to plug their ears, or maybe you can plug your ears. But from my point of view, there's no official right way to organize your books. Now, there are certainly accounting procedures that are specific for accountants. But what we want to do is say, we're not trying to make you into accountants. We're not trying to get you to hire accountants. We want you to begin by collecting the income, collecting information as it relates to the money going out, and develop a system that's going to work for you. For some people, it's one ledger. They record income on one side, expenses on another side, and then at the end of the month, they're able to summarize that. Other people have many different ledgers: income for sales, income for products or services, expenses for salaries, expenses for supplies, for your variable costs, and so on. So you can set up the system that works for you at this time. As you grow, that system will need to get more sophisticated. It will need to get a little bit more complex. But growth is a good thing, and having people to help us to manage that growth is important. But we, at this point, want to say, if you're not doing anything, don't feel like you need to shoot for the stars to start bookkeeping, but you need to just start with something. If you do these things, then you're already on your way. And these are 4 important things to help create a track record so that even if you don't do it, somebody else can. First thing, if you buy something but don't need to pay for it right away, obtain an invoice. Then have a box or a bag or something that has a label on it, invoices to be paid. You put it in there. Okay, so if you take something and you owe the person, get an invoice and put it in that box or that bag. Second, when you pay cash for something, get a receipt. Put that in a box called cash receipts. Every time you pay for something, get a receipt, put it in there. Now you're beginning to track where your money is going. If you sell something and you don't receive any money for it, then you make the invoice so that you can begin to see who owes you what. And now you put a box and you put invoices. We would call those accounts receivable, invoices to be received. So this is money that you're expecting to get. And then if you receive a payment, if somebody pays you, issue a receipt. And again, you have another bag or a box that is for receipts, and that is now part of your income. So you are collecting. You're beginning to develop a track record for everything that's going out and for things that are coming in, as well as for times when there is no cash being transacted. Somebody owes you money or you owe somebody money. But we need to begin tracking those things so that at some point we can go through all of that and make sense of it. I want you to turn in your book, and if you have your manual, you will see that there is this particular spreadsheet, and so it looks like this: money management cash transaction journals, and you actually will see that you have 4 of these in your book. It all depends on who was printing, for what page it was on, and what language it is in. So I can't give you a page number, but it is your cash transaction journal. And this is, again, just one sample of how you could keep track of your book. So we want to go, or keep track of your records. So we want to go through this particular statement and see if this is something that might work for you. On the left-hand side, you see your cash that is in. And so in this box, box 1, we would say that you would record all of your income. And so there are 7 lines that are there. So every day of the week, if you're open every day, you would write down what the date is in the first column, what actually transpired. And so if you were selling furniture, for example, you might write down that you sold a bed or you sold a couch. If you have a provision shop, you might not record anything because you're selling too many different things. But then the amount of the cash, so this is your gross sales. This is the total amount of sales that you have on a daily basis. And that then gets totaled at the end for how much you sold on for the course of that week. The next box then is for cash out. And this would be for your variable costs only. So whatever inventory or materials that you are using to create whatever it is that you're selling. So most of us don't buy our variable items for our sales every day, but there may be a number of days in a week that you are buying, especially if you're selling fruits and vegetables. But often it's not going to be daily. So what are you buying? You record this within 1 week. For your variable costs, the things that your customer takes away with you. All right, we're not going to deal with the other side of it until we go through the next slide, which is box 3 and box 4. And so in box 3 now, we are looking at cash out for fixed costs. So what did you pay in this past week for salaries, for rent, for transport, if that's part of your fixed cost, for insurance, for business registration, those types of things that you don't pay on a weekly basis. Usually it's monthly or semi-annually. And then the last one is other costs, things that you pay for. These would actually be probably for more of your fixed assets. Maybe you had to buy a new piece of equipment. It's a cost. Money went out for that, but it's actually something that you have an asset to show for. It's not something that you use as consumption, but that you invested in. So now what we would like you to do is at the top of the column, you see that you have your working capital. So we would like for you to start doing this tomorrow. If you're not doing any cash system at all, any record keeping, how much money does the business have when you get up tomorrow morning? Then you add to that your cash sales for the week from box 1. You subtract from that the cash that you took out for your variable cost from total 2. You subtract from that your cash that went out for your fixed cost, which is your total 3. And then you subtract from that any other cash that went out for other things, for investments in different assets. So you can see the formula down there at the bottom, your working capital plus your total 1 and subtract your totals 2, 3, and 4. And that should give you the subtotal of the cash that you now have available at the end of your week. So if you start this tomorrow, whatever day it is, you do it for 7 days, and then you figure out what your totals are. Now you go to the second column, the second side of this page, and that is where you write the same number that's at the bottom. You write that same number at the top. What is the subtotal of cash available? From there, now you need to make decisions for how to use that cash. For many of us, a lot of that's going to go towards our working capital that we need for the next week. What is it that you need to set aside to be able to buy your variable costs? Maybe you have salary payments coming up. Maybe you have a loan payment coming up. Maybe you have your own financial needs. Maybe you want to put some aside for your business goals or reinvestment so that you're saving towards something. Maybe you want to give a gift to the community. However it is that you determine from our last session to handle your profit, now we need to at least spend on paper how that cash is going to be used. And the goal is, at the very bottom there, you see your leftover cash. The goal is there to have 0, because money that's not assigned is going to find a leak somewhere. It's going to leak out. And so we want to take that subtotal of cash available, and we want to say we need this much for working capital. Goes in that bag or that envelope. We need to put this much aside for a loan payment. We want to take this much for ourselves. We want to put this much aside for our business goals, this much for savings or whatever you've planned. And then you should have 0 left over. So you want to allocate, at least on paper, all of that cash so that if somebody comes to you and says, I need this, you don't have that. The only discretion that you have based on the session 5 when we did the your own budget, you can only give from your owner's draw, what you've taken from. But the rest of that money has been set aside for the business, to protect the business, to help that business to grow and to prosper. All right, and so your leftover cash should be 0, and you should allocate that. What I think you should do right now is take time to pause and to run through some examples in your group. Somebody who might say, okay, starting tomorrow, this is what I have. This is what I tend to get on a daily basis for sales. This is what I have coming up in this next week for variable costs, and just kind of do some projections and then run through an example of, okay, if we had this much in sales and we had this much in expenses, this is the total amount that we would think we'd have left over. How do we allocate that out so that our leftover cash is 0? Before you do that, though, let me just go to the second page, or the page that's on the other side in your book. And this is where we're going to record the non-cash transactions. Many of our businesses tend to give credit. We also take things on credit. And we have to capture that in a way that will allow us to know what is outstanding and what is expected from us to pay. So on the left-hand side, we see accounts receivable. Those are accounts that we are expecting to receive. All right, that's money that a customer has said, let me take this and I will pay you later. So you've given out something, a portion of your inventory or your stock, and you are expecting that person to pay it back. So you put the date, you put the customer's name, you put the amount. I would also recommend you take their phone number, some way to be able to reach them, to contact them, so that you are able to track that down. But it also will give you this ability to see on a weekly basis, how much are you extending in credit, and how much are you actually getting paid for that. If it ends up being a net loss consistently, those of you who say we have to do that to stay in business, then you have to really rethink that, whether that's a wise decision for you, or how could you change that to make it wiser. On the other side is our accounts payable, and these are accounts that we are expected to pay. So these are a liability for us. Somebody can hold us liable for it. So the due date, the day that we have to pay it, who the vendor was, and the amount. How much did you take in this past week that you will have to pay back at some point? And so we want over the course of each week for you to keep records of both. So on the other side, we have your income coming in and your expenses going out. Those are what we call the cash transactions. And on this page, we want to look at the non-cash transactions. There's still a transaction taking place, but no cash is actually being exchanged. So take some time, pause this now, and go through some examples. And you will see again that there are 4 of these in your book. And our expectation is that you would start this tomorrow and do it every day for 4 weeks. And the reason why we do this now is so that you have time, if you have any challenges in doing this, to bring this in and to talk to your facilitator about the challenges that you are experiencing. So I'm going to have you pause right now, and then we will come back and continue on. Okay, for the last part of our session today, we want to look at the basic accounting equation. And you will find this again in your manual. I'm not sure what page it's on, but it's in session 7. And the basic accounting equation is understanding this is going to help us to do our session next week, where we are looking at the income statement as well as the balance sheet. The basic accounting equation for everything in life is assets equals liabilities plus owner's equity. And we're going to take that apart. We're going to look at it very carefully. But essentially, this is the equation that provides the underlying framework for recording and summarizing economic events. All right, so this is the basic equation. If you understand this equation, it's going to help you significantly in understanding the accounting that will take place in your business. What are these 3 words? What do they mean? Assets. Assets are the things that we have in our business that are either claimed by creditors or owners. So if you think of everything that your business has, you have a building, maybe you have some land, maybe you have some inputs. All of those are assets. Those are things that the business owns. How do we explain that those things got there? Well, they either got there through creditors. So we have a liability. Maybe we took a mortgage from a bank. Maybe we took a loan from a family member. Maybe we owe another business something. So the claims on those assets are either by those creditors, or the owner can claim those things. The owner either helped contribute to those assets by injecting capital, by having sales, and after we take out the expenses, the profit stayed with the business, and so that increased the assets. And so assets are those things that the business owns that have claims on them on the other side of the accounting equation, either through liabilities or through the owner's equity. So we are going to take those apart a little bit. So assets, again, resources that a business owns. And we talk about that there are current assets and there are fixed assets. Current assets are those assets that you can turn very quickly into cash. So cash, of course, is a current asset. Your stock or your inventory is a current asset. Those are things that you can quickly turn into cash. People that owe you money, accounts receivable, those that owe you money, is also a current asset, because hopefully you can find them and get them to pay. Then we have our fixed assets, and those are things, that we own that it takes more time for us to turn those into cash. So land that we own, or machinery that we own, equipment, furniture, things that the business owns that you wouldn't turn into cash very quickly. Okay, so those are the different types of assets that we might have. Liabilities now, on the other side of the equation, are claims against those assets. So those are creditors to whom money is owed. These might be very short-term, less than 30 days. We call those accounts payable. That means you have an electricity bill that you need to pay. You have a water bill. You took some inventory and you have to pay in less than 30 days. Those are accounts payable, very short-term accounts. Then we have loans, which are short-term loans, which we would say is less than a year. And then notes payable would be anything that is a loan agreement that you agree to pay for longer than a year. And so those notes payable And accounts payable, those all add up to be your liabilities, and those are claims against the assets by people outside of the business. The third one then is owner's equity, and the owner's equity is, of course, now the owner's claim on those assets. So this would be the investment of the owner, as well as the leaving, as I said, of the revenue. So you have the revenue, the sales minus the expenses. If the profit remains in the business, that the business contributes to that becomes the owner's. But we have to subtract from that any drawings or expenses that are taken out of that, and all of that will go towards the owner's equity. But we're going to parse this out a little bit further as well. So the basic equation that we said is assets equals liabilities plus owner's equity. Turn to your neighbor and repeat that. Assets equals liabilities plus owner's equity. Good. Now what we want to do is to expand owner's equity a little bit further because it gets a little bit more complicated. We have our assets equals liabilities, and then owner's equity is actually 4 different main categories that we're looking at. We are looking at the owner's capital, so how much money did you actually start the business with? But we have to subtract from that what money you've taken out, the drawings that you have removed from the business. We want to add back into that the revenue, and that is any of the business activities entered into for the purpose of earning income. And so here it says common sources of revenue are sales, fees, services, commissions, interest, dividends, royalties, rents that you receive. Those are all different types of revenues. And then we want to subtract from that the expenses, so the fixed expenses and the variable expenses that you have. So owner's equity, when we broaden that out, it's 4 different things. The capital that you put in, subtract the drawings that you took out, add in the revenue, and we subtract out the expenses. And all of that then equals what is the owner's part of the assets. So when you look at this equation again, and this is what I think is beautiful about it, is on the one side you have your assets. And really what you're asking the question is, how did these assets get here? Well, they either got there through liabilities. You took some loans, and maybe you still have some loans outstanding. If you paid off your loans, it becomes now owner's equity. Or the assets got there because the owner put capital in, or you've had revenue. And once we subtract out the other things, that actually has turned into a profit and has grown your business. Right? Expenses are the cost of assets consumed or the services used in the process of earning the revenue. Common expenses are salaries expense, rent expense, utilities, tax, and so on. So now what we want to do is spend some time practicing using this. I'm going to take us through this slide, and then I'm going to ask you to, again, pause and to do an assignment together and an example. But let's look at this first. Are the following events recorded in the accounting records? Remember, we said that we first need to identify, and then we need to track, and then we need to communicate. Those are the 3 main activities associated with accounting. So let's look at whether these are events that we need to record in the accounting records. First is that the supplies are purchased on account, and that means on credit. Is the financial position, either the assets, the liabilities, or the owner's equity of the company changed? If you go to a place and you get supplies for your business, and you say, I'm not going to pay now, I'll pay you later, you come back to your business with those supplies, has the financial position of the business changed? What do you think? If you said yes, it has, then you are right, because our assets have increased. We now have supplies that we didn't have before. Okay, so our assets have increased, but that's not the only thing that changed. We also now have a liability. We now owe somebody for that asset that we just took. We owe somebody for the supplies. So our assets changed, but our liabilities also changed, because now we can show that how did we get that asset? We got it through a liability. We owe that person money. So did the financial position of the company change? Yes, and we do record that transaction in this accounting equation. The second is an employee is hired. Did the financial position of the company change when we hired the employee? What do you think? You can pause if you want. If you said no, then you are correct. The financial position of the company did not change. Once person has worked for us, then it does change because then we owe them money. But simply hiring the person, we don't own the person. They're not an asset that we can record. They're not a liability. They eventually will be an expense when we pay them salary, but they will also hopefully contribute to the income as well. But hiring a person does not change the financial position. The third one then, owner withdraws cash for personal use. Did the financial position of the company change when the owner withdraws cash for personal use? What do you think? And again, if you said yes, the financial position of the company changes, then you are correct because your assets decrease, right? The owner takes cash out. Cash is an asset. Cash goes down. How do we explain that the cash went down? What else changes? Well, the owner's equity also decreases because you've drawn money now out of the asset. So you can't take an asset out and then not explain it. You have to explain it by saying, well, the owner took a drawing out. And so we do record that. What's interesting about the accounting equation, when you look at it, assets equals liabilities plus owner's equity, is now we are beginning to record both cash and non-cash transactions. The earlier example that I showed you and had you go through, I had you record your non-cash transactions on the back of your spreadsheet there, where you were tracking your income and expenses on a daily basis. That's called a cash system, and in a cash system, you don't record non-cash transactions. So you might make a sale. Somebody takes product and they tell you they'll pay you later. You can't record that on that. You have to record it on the back, where you're keeping track of people who owe you money or money that you owe. In this system, and this is called an accrual system, you would write that down that, yes, a sale did happen. The person will pay you, and you would record that as revenue, but you would also record that as an accounts payable. And we'll go through more of that as we go through this example. So in your book, you have a page that has these different transaction analysis about Ray Neal, an example there. But on the next page, you should have a sheet that looks like this. And so what I'd like for you to do is to go through, to pause this, and to go through all of this, the different examples that you have, and record them as you think best in this, and then we will come back and do that together. So starting with transaction 1, Ray Neal decides to open a computer programming service, which he names SoftBite. On September 1, 2012, Ray Neal invests $15,000 in cash in the business. So what you need to ask yourself is what changes in the business? He takes cash, $15,000 cash in the business. Where does that go? What changes in the business? And I give you a little hint here. Every time you have a transaction, you end up needing to record it in 2 different places because every transaction ends up having an impact in 2 areas. So I'm going to have you pause this right now and try to work through this on your own, and then we'll come back and do this together. All right, so we want to now take a look at how you did. I know that it can be a little confusing, and almost always what we see is some people get it very quickly and some people struggle more. So if you're the one that gets it very quickly, don't speak too fast to let others be able to wrestle through this and come up with it on their own as well. So the first transaction, Ray Neal decides to open a computer programming service business, which he names SoftBite. On September 1, 2012, Ray Neal invests $15,000 cash in the business. So the question we want to ask is, what changed in the business? Well, obviously, he put cash in, so our cash goes up. Now we have an asset, $15,000 worth of cash. How do we explain that asset? Where did that asset come from? Is it a liability? No. Owner's capital? Yes. The owner put $15,000 of his own money in as an investment into the business. Okay, so you can see it's recorded twice. It's recorded once on the asset side, and it's recorded once on the owner's equity. So this owner has that claim on that specific asset. Transaction 2, purchase of equipment for cash. SoftBite purchased computer equipment for $7,000 cash. Okay, so SoftBite obviously needs computers, And so the owner takes $7,000 in cash and buys equipment. So what changes in the business? Well, in this case, he takes cash, $7,000, so cash is going to go down. But how do we explain, where did that cash go? Well, that cash went into equipment. And so what this owner has done, what Ray Neal has done, is he's taken an asset in the form of cash, a current asset, and he's changed it into a fixed asset in the form of equipment. So what you can see here is there's two transactions recorded, right? Cash goes down $7,000, equipment goes up $7,000. It balances out. And both of those are recorded on the asset side. So for those of you who like algebra or other things, this is not a situation where you have to do on opposite sides of the equation every time. This is one asset that's turned from cash to equipment, and that's the only place it gets recorded. The financial position of the company doesn't really change in terms of increasing or decreasing the assets, but rather we're just changing an asset from one form to another. Transaction 3, SoftBite purchased for $1,600 from Acme Supply Company, computer paper and other supplies that are expected to last several months. The purchase is made on account. Okay, that means that Ray did not pay for it. He went to the Acme Supply Company. He got computer paper and other supplies. He said, send me a bill for it. He received an invoice, and he took the supplies back to the business. So what changes? Well, in this case, supplies goes up $1,600. How do we explain this asset? Well, it's actually a liability. In this case, it shows up under accounts payable. Now, one of the things I want to point out here is that you can have as many different assets as you need in terms of the columns. Okay, Ray Neal happens to have supplies and equipment. You don't see him listing land or buildings because that's not what he's doing. He also has under liabilities just accounts payable. So he's not planning on taking a short-term loan or a long-term loan. He just has the accounts payable, which again is less than 30 days. Owner's equity is pretty usually owner's capital minus the owner's drawing plus the revenue minus the expenses. And so you can see actually as well as we enter these that the plus or the minus sign needs to go in for each cost so that we know whether we're adding or we're subtracting. Almost always owner's capital is being added. Owner's drawings is almost always subtracted. Revenue is almost always added. Expenses are almost always subtracted. But other things might go up and down. Supplies, as we consume them, we will have to subtract. Cash is always up and down depending on what happens. Accounts receivable, the same. Somebody owes you money, it's a plus. They pay it off, it becomes a minus, and so on. So we always want to make sure that we put the plus or the minus in front. So here we have supplies in the amount of $1,600. And the liabilities is a positive number. As we pay it off, we will be able to reduce the amount that is owed. All right, transaction number 4. SoftBite receives $1,200 in cash from customers for programming services it has provided. SoftBite makes a sale now. They do some service for somebody, and they are paid $1,200 in cash. So what changes in the business? Well, obviously cash goes up $1,200. Now we have an asset. How do we explain this asset? To what do we owe this cash? Is it a liability? No. Is it owner's capital? No. Did the owner draw money? No. Is it revenue? Yes. Okay, now you've made a sale. So cash goes up $1,200. How do we explain that? We explain it by a revenue. We had $1,200 in a revenue. Transaction 5. SoftBite receives a bill for $250 from the Daily News for advertising, but postpones payment until a later date. So they get a bill because they did some marketing, and but they get it and they put it down. I'll pay bills in a couple days. Let me just put it down here for now. So what changes in the business? Well, now marketing is an expense, right? It's something that you are using in order to run the business. And so we enter it in as an expense, but we haven't paid it yet. So cash is not affected. We say we're going to pay it later, usually less than 30 days. It becomes part of an accounts payable. So our accounts payable goes up by another $250. We owe the Daily News $250, and we explain that liability as an expense. This is a marketing expense. Transaction 6. SoftBite provides $3,500 of programming services for customers. The company receives $1,500 in cash and bills the balance of $2,000 on account. Okay, so we do some work for a customer. The customer pays $1,500 now and says, I'll pay you the $2,000 later on. So now we have a little bit more complicated of a situation. What changes in this situation? Well, we have $1,500 that we receive in cash, and we also have $2,000 in accounts receivable. Okay, so we received the $1,500 in cash. We know that this person still owes us $2,000. How do we explain this $3,500? Again, it's not capital, it's not a liability, drawings, it's revenue. It's a sale that we made. Now that sale is going to be paid in two different ways, cash as well as a future payment. And so we record the whole thing there, and they have to match. Those numbers still only get entered in a total of twice, but one of them is broken into two different areas. Transaction 7, SoftBite pays the following expenses for September. All right, so now maybe it's getting to the end of the month, and we make a store rent payment of $600, salaries of employees of $900, and utilities in the amount of $200. Okay, so we're paying cash for all three of these. So the first one, we pay rent for $600, cash goes down $600, and we show our expenses, almost always again as a negative, goes down $600. We pay our salaries of $900. Cash goes down $900. We explain that decrease of asset through an expense. And then utilities are paid. Our electrical bill, our water bill, maybe our internet are paid. Cash goes down $200, and our expenses also go down for $200. All right, transaction 8. SoftBite now pays the $250 daily news bill in cash. So in transaction 5, we received the bill for the marketing, and now we're going to pay it. Now, this is where many people get confused, and they think that they need to enter it in as an expense again, but we don't want that double entry to be there for that. We've already said it's an expense for the business, for running the business. It's a fixed cost, right, of $250. Now we're going to pay the cash, so cash is going to decrease, and now this time we want to decrease the accounts payable. So we took care of that debt, it's now gone. We don't enter it into the expense again. It's already been entered in there. Now we're taking care of that debt. Cash goes down, and our accounts payable, what we owe people, also goes down. Transaction 9, SoftBite receives $600 in cash from customers who were billed for services in transaction 6. So remember in transaction 6, we did a service. They paid $1,500. They still owe $2,000. Now the customer came in and made a payment for what they owed of $600. Okay, so cash goes up $6,000, and our accounts receivable, the money that we expect to receive from customer, goes down $600 because now they've taken care of a portion of that. So it reduces the amount that they owe. We've taken that asset, accounts receivable, and turned it into a more fluid asset by actually having the cash. Last transaction, Ray Neal withdraws $1,300 in cash from the business for his personal use. So now Ray Neal, it's the end of the month, he looks at how he's done. He says, I'm taking $1,300 in cash. And so cash goes down $1,300. How do we explain that? Is it a liability? No. Is it capital? No. Is it drawings? Yes. So cash goes down $1,300. And the owner's equity also goes down through drawing $1,300 by Ray Neal taking money out for his own personal use. Again, he has the right to do that as the owner. We can look at, though, whether this is a good decision. So now let's look at each of these categories. And I hope you did this as well. You need to add, where are you at finally with cash? You started with $15,000, you subtract $7,000, add $1,200, add $1,500, and so on and so forth, all the way down. Same with accounts receivable, supplies, equipment, accounts payable, and so on for each line. And hopefully you came up with this. So at the end of the month, we have $8,050 in cash. We are owed by customers. We expect to receive $1,400. We have $1,600 in supplies, and we have $7,000 in equipment. When we add all of our assets together, we get a total of $18,050. Now remember our equation. Assets must equal our liabilities and our owner's equity. So now we go to the other side of the equation and we want to see, does it equal? Liabilities, we have $1,600. And that's the amount that we still owe for the supplies that we took. Owner's capital remains $1,500. That doesn't usually get subtracted. If it's subtracted, it comes out of the owner's drawing, which is what we see in the next column. We had a revenue of sales in the amount of $4,700, and we had total expenses in the amount of $1,950. When we add our liabilities and our owner's equity all together, we come up with a total of $18,050. And so you can see that your assets are equaling your liabilities and your owner's equity. Now I know that this is the first time that we're doing this, and it takes some practice to figure out how and where to enter these. And that's why in the book you have some practice worksheets, you have some other scenarios that you can go through to practice this. But if you can do this, if you can learn to use this equation and lay this out in this way, it becomes very easy for you to do an income statement, which we will look at in our next session, as well as a balance sheet, which we will also look at, because all the information is there. And so if you do a type of business that doesn't have a ton of transactions on a daily basis, this becomes very easy to do, and it will help you generate your own reports as well. So your activity, your assignment for this next week is to do the money management starting tomorrow, the cash transactions journal, as well as the non-cash transactions journal. If you're not doing any bookkeeping at all, that's what we would like you to start with. If you are doing your own and want to keep doing your own, please make sure that you are capturing everything that we have laid out in these other formats, non-cash and cash transactions, and then bring those back in next week so we can begin to look at those together. All right, return with any questions or observations for your business, and we would like for you to commit to doing this every week for the next 4 weeks. All right, thank you so much. We are going to stop here for session 7, and next week the next session we will begin looking at session 8, which is income statements and balance sheet. Thank you for being with us.